Breaking news from JP Morgan's big shareholder meeting down in Florida. Shareholders give their support to Jamie Dimon, who retains his chairmanship and, of course, stays on as the CEO of the big bank. Welcome to Mean Street, everyone. I'm Dennis Berman, subbing for the missing Evan Newmark. Glad to have you here this afternoon. Let's go straight to the JP Morgan story. Brett Arends, who's visiting with us from Boston, wrote a provocative column on SmartMoney.com that basically makes the case that we're all JP Morgan now. Brett, you made a case. I disagree with you severely,
okay.
But let's hear what you have to say.
Look, I think that what people need to, one of the things that really strikes me about this is how much of what happened at JP Morgan and happened at other banks can be attributed to flawed thinking that dominates the world of finance today. What was really interesting to me was that this news came out just after my very good friend James Montier at GMO, who's one of the smartest strategists out there, had made a presentation to the CFA Institute about exactly the same topic. About 3 days before JP Morgan released the news that they'd lost all this money, James was talking about how, everyone is relying upon these computer models. They don't understand what risk really is. They use sort of things like value at risk, which are almost like paper umbrellas, that they fail you exactly when you need them. That these problems are endemic about the way we think about finance, and that it's not just, one rogue trader here or one rogue trader. These things will keep happening.
Right. Now, Brett, I think a lot of us understand how VAR in particular got a number of banks and investors in bad positions during the financial crisis. And yet I read through your piece, and I found myself disagreeing, Brett. Largely because you don't present necessarily a better way of doing things. Should we get rid of the computers? Should we get rid of the approaches we have towards risks generally? Is it not possible, or is it basically impossible, that any bank can prevent a loss? It seems
well, no,
logically
the bank is obviously never going to avoid losses. My point is that as an investor, people are making, in many ways, obviously on a much smaller scale, a lot of these same errors. You can't outsource judgment to models. I am always amazed. I used to be an analyst, and I am always amazed at the religious treatment that people give to these, we have a computer model.
Right.
I talk to people and they tell me, we have a proprietary algorithm. And I feel like grabbing them by the lapels and saying, if it's any good, everyone else is copying it. And second of all, look at the assumptions page on your model. These things are basically contraptions. They are all flawed. They are only ever guides. They can never, and people put way too much store in them. The incentive system is all wrong. The incentive system is fascinating, and people, I think, still haven't fully got their head around it, because most people in America live in a world where basically if you succeed, you get rewarded, and if you fail, you get punished or penalized in some way. And they don't understand that in finance, it doesn't work like that. To the same degree, and that's a really dangerous system we have.
Okay, Brett, here's my thought on computers. Computers obviously can be flawed, assumptions can be wrong, but you seem to assume, however, that human judgment is at a somehow superior level to machine judgment. One could argue that human judgment oftentimes is much more flawed than a mechanical model that eliminates emotion and tries to come up with an answer completely by rational decision making.
We're just going to have to agree to disagree. You referred a second ago, I think it may have been a slip of the tongue, to computer judgment. Computers have no judgment. It is purely a system of building, formulae. They have their uses. I'm not a Luddite. What I am saying is that, the extremists are the people. I mean, there's a cult now which sort of outsources almost everything to these things. I mean, it is astonishing to me. And you have to retain judgment, and you have to retain a degree of skepticism about these things. And, people don't, it's fascinating to me. I'll tell you one thing. What strikes me, I'm very lucky in my job because I get to speak to and interact with from time to time people who are absolute grandmasters at investing, people who have been, beating the markets for 20 years or 30 years or longer, who are superstars. There's very few of them, but they're extraordinary. And one of the things that strikes me is that they read a lot of history, and they also read a fair amount of literature. They're not mathematicians on the whole. They read, I was just reading a note today from a brilliant fund manager in Europe, and he starts talking about Edmund Burke. And it's fascinating to me that the people who really do outperform and produce super risk-adjusted returns often find that competitive edge away from the computers by exercising judgment and by tapping, for example, the thousands of years of human history.
Right, okay.
I just think that this stuff is underappreciated. That's my point.
I agree with you, Brett. Perhaps we need to all read a bit more Pride and Prejudice, understand what happens inside the human soul. But as you said, there are very few people who can beat the market over long periods of time. And those people oftentimes are using their human judgment. So what is better, the human or the computer? Right now, you seem to say that the computers are not doing their job at JP Morgan. And for that reason, we are all JP Morgan. Now, check out Brett's column on smartmoney.com. It's called We're All JP Morgan Now. Brett, thanks so much for joining us.